Welcome to our new IFRS Educational Fund Series. It is an initiative of Audio Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standard IFRS through a multiple choice question and answer approach. It is intended to make learning on intellectual assurance fun. In this session, we shall be considering 10 questions to which the answers have been provided on IAS 10. This is the standard on events after reporting period. Viewers or subscribers have 30 seconds to select or choose the answer to each question. The answers to the 10 questions are revealed at the end of all the questions. Please enjoy it. Question number 1. Events after reporting period are events that occur A, between the end of the reporting period and the day the external audit is concluded. B, between the day the financial statements are approved and the day the external audit is concluded. C, between the date the draft financial statements are ready and the day the finalized ones are ready. D, between the end of the reporting period and the day the financial statements are authorized for issue. E, between the date the financial statements are authorized for issue and the day the external audit is concluded. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 2. The draft financial statements of an entity for the year ended December 31, 2022 were ready on January 4, 2023, and the board authorized them for use on February 4, 2023. The financial statements were received by all shareholders by February 14, 2023. An annual general meeting was held on May 14, 2023, when adoption was done. On May 17, 2023, the financial statements were filed. Which of these dates is the effective date of authorization for issue of the financial statements? A, January 4, 2023. B, February 4, 2023. C, February 14, 2023. D, May 14, 2023. E, May 17, 2023. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 3. In line with IAS 10, events that are indicative of conditions that arose after the reporting period are called dash. A, year-end events. B, post-period events. C, non-adjusting events. D, adjusting events. E, post-balance sheet events. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 4. In line with IAS 10, events that provide evidence of conditions that existed at the end of reporting period are called dash. A, year-end events. B, post-period events. C, non-adjusting events. D, adjusting events. E, balance sheet date events. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 5. With respect to events after the reporting period, recognition or remeasurement of items of financial statements will arise on dash A. Adjusting events only. B. Non-adjusting events only. C. Adjusting and non-adjusting events. D. Future events as proactive reporting. E. Contingencies. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 6. Which of the following holds? A. Contingent assets cannot arise from adjusting events. B. Contingent liabilities cannot arise from adjusting events. C. Contingent assets and contingent liabilities cannot arise from adjusting events. D. Contingent assets and contingent liabilities are not adjusting events. E. Contingent assets and contingent liabilities cannot arise from non-adjusting events. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 7. Where dividends are declared after the reporting period, but before the financial statements are authorized for issue, an entity A. recognizes the dividends as liability, B. does not recognize the dividends, C. elects whether to recognize or not to recognize the dividends as liability, D. makes a provision for the dividends, E. adjusts the dividends of the retained earnings. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 8. An entity shall not prepare its financial statements on a going concern basis as a result of all of the following, except management A. determines that intends to liquidate the entity. B. determines that intends to stop trading. C. determines that it intends to buy out the owners. D. determines that it has no realistic alternative than to bring the entity to an end. E. is aware of uncertainties related to events that may cast significant doubts on the entity's continuity. Time counts. 10 seconds gone. 20 seconds gone. Time up. Question number 9. A non-adjusting event concerning a particular reporting period on capital adequacy ratio will have which of the following effects in the financial statements? A. It will increase or decrease share capital without affecting debenture. B. It will affect share capital and debenture either as an increase or a decrease. C. It will lead to increase or decrease in total equity. D. It will lead to increase or decrease in statutory deposits. E, it will neither increase nor decrease items in the financial statements. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 10. For each material category of non-adjusting events after reporting period, which of the following can be disclosed? A, the nature of the non-adjusting event. B, an estimate of the financial effects of the non-adjusting event, if possible. C, a statement that an estimate of the financial effect cannot be made. D, all of the above. E, A and B. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. We proceed to review the answers to all of the questions. Question number 1. The answer to question number 1 is D. Between the end of the reporting period and the date the financial statements are authorized for issue. The period between the date of approval of the financial statements for issue and the end of reporting period concerned is the emphasis for events that are to be reported under IAS 10. D is the answer to question number 1. Question number 2. The answer to question number 2 is B, February 4, 2023. This date is the day that the board authorized the financial statements for issue. Date of authorization for issue is the determinant. B is the answer to question number 2. Question number 3. The answer to question number 3 is C, non-adjusting events. The statement in the question is the description of non-adjusting events under IAS 10. C is the answer to question number 3. Question number 4. The answer to question number 4 is D, adjusting events. The statement in the question is the description of adjusting events under IAS 10. D is the answer to question number 4. Question number 5. The answer to question number 5 is A, adjusting events only. Adjusting events are the events that necessitate recognition or remeasurement of items after reporting period. The impact on amounts already recognized or the need to recognize fresh items or amounts. A is the answer to question number 5. Question number 6. The answer to question number 6 is D, contingent assets and contingent liabilities are not adjusting events. While events leading to adjusting events or non-adjusting events can give rise to contingent assets or contingent liabilities, contingent assets and contingent liabilities in themselves are not adjusting events. Adjusting events necessitate adjustments to the amounts in the financial statements, whereas adjustments are not done on the account of contingent assets or contingent liabilities. D is the answer to question number 6. Question number 7. The answer to question number 7 is B, does not recognize the dividends. Dividends declared after reporting period, but before the financial statements are authorized for issue, do not create any obligation on the part of the entity and thus are not recognized in the books. When the financial statements are subsequently authorized for issue, The dividends remain unrecognized, but disclosures are made in the notes to that effect. They become liability when approved at the annual general meeting by shareholders. B is the answer to question number 7. Question number 8. The answer to question number 8 is C. Determines that it intends to buy out the owners. That is, management determines that it intends to buy out the owners. The options in all the answers, except option C, are grounds for an entity no longer to be considered a going concern. C is the answer to question number 8. Question number 9. The answer to question number 9 is E. It will neither increase nor decrease items in the financial statements. Non-adjusting events do not lead to adjustments or revisions of amounts recognized in financial statements, irrespective of what the events are. Disclosures are made on them when they are material. E is the answer to question number 9. Question number 10. The answer to question number 10 is D, all of the above. The disclosures from A to C are the required disclosures as applicable for material non-adjusting events after the reporting period in line with IAS 10. D is the answer to question number 10. That is all for this set. Thank you for joining us for the set 1 of IAS 10 events after reporting period. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all of the subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and others in the service are reserved for OJ Inspiration Limited. Thank you once again, and bye for now.